All right, so the question is, how do crypto ETFs work? Well, you got to understand first of all basically what is an ETF. An ETF stands for an exchange traded fund. So exchange is the key word. It's basically pretty much like a stock, like it's available on a stock exchange, and it's a fund, and there are other funds as well. So crypto ETFs are not the first type of ETF. There are other ETFs that basically all of these things track underlying assets. So there have been for many years ETFs based on gold or real estate or things other than stocks, right? So most people go to an exchange for stocks, but if you want to try something else, then an ETF is a nice accessible way of being able to get that price action without having to buy the underlying thing, which in some cases there may be barriers to entry or it can be difficult or whatever. If you're just used to stocks, then you can just buy an ETF. It's probably the easiest way to get exposure to the underlying, and that includes crypto. Now, how do they work? How do they actually track these things? Well, what happens is if there's a new ETF and then a bunch of people, I guess it's kind of like a little bit like an IPO, but in the sense that they issue new shares in this fund. Then if you start buying, then what the administrators of that fund will do is start buying the underlying asset, okay? Because they're audited. They can't just the reason that the thing tracks crypto or tracks real estate accurately is because on the back end they're actually buying that asset as well. So that's exactly what happens with all of these ETFs, including a crypto ETF. And if there's a lot of demand for an ETF, then the fund administrators will buy a lot of crypto. And if a lot of people are selling the ETF, then they have to sell the crypto that makes up the ETF as well. And there's a bit of a delay. I don't know what it is exactly, but I think it's about a day or two. So for example, something that happened recently was that there was a big sell-off in crypto, fairly big sell-off. And then if you looked at the ETF inflows and outflows, there was a lot of outflows in the days after because the fund was forced to sell off the crypto because people had been selling off the ETF itself. So there is a bit of delay, but that the way that they work, it's permissible. It is totally fine, but it does have to more or less be one for one. They are audited by law, and an ETF. So also with stocks, you won't be necessarily protected with stocks if the price goes up or the price goes down. You have to accept the risk, but there are still some legal protections over your money, right? Like your broker can't just run away with whatever your portfolio value is. Wherever you're holding your ETFs, the broker cannot just rip you off. You're protected against that, and that includes whether you're holding regular stocks or whether you're holding ETFs. That you should have some base level of consumer protection. And one of the nice things is that there's more protection on ETFs than there is just on general, let's call it naked or vanilla crypto. Because if you own crypto on an exchange, typically won't be insured. It certainly won't be like FDIC insured or anything like that. Now this is starting to change. So for example, some of the crypto exchanges, Coinbase is a notable one, do have insurance if you hold regular crypto there, but most exchanges don't have insurance. And if you take your coins out of the exchange and do what's called self-custody, well then you're not insured at all. It's all on you. The ETFs is completely different, right? Because ETFs are basically like a stock. You have that protection when you hold it at your broker. Custody, I believe by law, should be insured some amount. I think depends on the country, but I believe that is the case. And what you're seeing also with ETFs is there's now a Bitcoin ETF. I think there's an Ethereum ETF, and you can expect there to be more ETFs of the major big cap cryptos in the coming year for sure. And I don't know about this month, but at the time I'm recording this in March 2025, but in the coming year it's expected that there will be more I think probably Solana ETF might be the next one. There might be XRP, Litecoin, if not already. I think will also be coming. They're all expected to give a general pump to the market. I mean, what happened when the Bitcoin ETF came out? There was a bit of a pump, but I think a lot of people thought that there would be new investors flocking to ETFs, and therefore it would pump the overall market more or less permanently. That's not really what happened. What actually happened was that a lot of people who held regular crypto in a crypto exchange, they sold their holdings and then bought the ETF instead. So they basically rolled out of regular crypto and into ETFs. So most of the movement was just moving from one to the other. There weren't so many brand new investors who only ever buy stocks and ETFs. Were waiting for the right moment for the first crypto ETF, in this case a Bitcoin ETF, to come into existence and then go and buy it. There were hardly any new investors like that. But there is a lot of euphoria in the market, and people get a bit heady about that. But nevertheless, overall, it's still a good thing in general for adoption. It's definitely a good thing. It's certainly not a bad thing. And yeah, another big reason as well for people to buy crypto ETFs is because they're like regular stocks or like other ETFs or like other funds. Then I believe that it's more easy to have them be a part of pension funds, whether that is an occupational fund that's managed by your company that you don't really have much of a say in, or whether it's like, I believe, something like more similar to like a 401k or an IRA or something like that. I don't know the exact specifics on how it works in America, but my understanding is that ETFs are easier to access for these sort of use cases. And if you buy crypto, right, although you might treat it as your pension, it can never, raw crypto can never be part of any kind of pension fund, whether it's non-discretionary or that you don't have much control, or whether it's discretionary and you're picking and choosing everything. The regular crypto has never been able to be part of a pension fund. There are laws about what can be in a pension fund. It has to be mature type of security. I mean, crypto itself is not mature, but ETFs are. There's been a regulatory framework around them for well over a decade, if not 2 or 3 decades. I don't know exactly, but a very long time. So yeah, that is how crypto ETFs work. They are one-to-one, that they are backed. They are regularly audited. There's no way, there's no getting around that. And to be honest, you want that as an investor. You want that confidence, and typically you'll be insured, and you can then use them as part of for example, a long-term investment, like a pension type arrangement or similar. So I hope that explained well for you what you wanted to know. Let me know what you thought. Give this video a like, and ask me any questions down below in the comments. I will see you again soon. Take care. Bye bye.